Hey, what's up, everyone? I'm Jon Blair with Free to Grow CFO, and we've got
Josh from Luminous.
And we are going to be talking today about reconciling inventory, really closing the books. If your brand is on Luminous, at the end of every month, you need to do a couple key things to make sure that you're properly recording cost of goods sold and ultimately reconciling your inventory valuation in QuickBooks to the inventory valuation in Luminous. And so today, I guess you're going to get a masterclass on how to do that. Ready to roll?
Let's do this.
All right. So we're going to talk about three key things here today. The big picture is reconciling Luminous, the stock snapshot report, right? Then we're going to talk about a sneaky little thing that can happen with something called accrued accounts payable that you want to just be aware of. These are inventory items that have been received but not billed for yet. And then we're going to talk about what should you do in QuickBooks with prepayments or deposits on inventory and in-transit inventory to make sure that it doesn't muck up this reconciliation. So I'm going to draw some things on the screen here, and then we're going to go back to where we're pulling this data from in Luminous. So here's what we have to do here. We need to go back to, honestly, accounting school. And what I'm drawing here on the screen is the classic equation for inventory. You have first beginning plus POs, and really I wrote POs because it's easy to write on the screen, but it's purchases received in the month minus cost of goods sold for the month, the landed product cost of the items that you sold in the month, that equals ending. So how do we take this and use it to get the right data from Luminous and put it into QuickBooks? There's really a two-step process here. The first one is we need to record cost of goods sold from Luminous in QuickBooks. And then the second step is to validate ending inventory and confirm whether or not it ties after the cost of goods sold adjustment to what the QuickBooks ledger has as an ending inventory valuation. If they don't tie, there's a step-by-step process we have to go through to find where the issue is. So first things first, Josh, where do we go in Luminous to get the landed product cost of what was sold in a given month?
So we can go through the first report that I would recommend here. If we come into Luminous and we click into reports, we're going to go ahead and we're going to search up and we're going to find the COGS Insight Dashboard. And so this report will give us a couple different things. It allows us to filter by order status, order date. Most typical is to filter by ship date, and you can select a range, typically the previous month or the current month that you're going to be reconciling. You're also able to filter by channel as well if you need to get cost of goods sold by channel. And what this report will give you, it'll give you total cost of goods sold by SKU in one section, and then it also gives you a section in Luminous of any products and their quantities sold that did not have a cost of goods sold tied to this transaction. So once you take a look at that, we also have a transaction COGS report, which actually enables the user to come in, filter by any of the transactions that had missed COGS, and you can actually go through and fix that prior to running some of these next steps.
Awesome. So this brings up a point that I didn't think of. Do you guys recommend when you pull up the COGS Insight report that if there's a zero cost for a particular SKU, that there's any intervention that's done on the cost for that particular month?
Yeah, no, that's actually a very common thing in systems such as Luminous, where you may have missed the reconciling of an inbound shipment, so landed cost wasn't recognized. But you are able, again, on this transaction COGS report, you're able to come in and update the cost of goods sold for certain transactions. Another great tool as well is we're able to click into the SKU itself and then identify anything that may have gone wrong or something that wasn't logged on the cost layer itself. A recent update we've rolled out is you can actually see the history of a cost layer. So how was this created? What was the landed cost? You can see here like the receipt that was tied to this cost as well. So definitely want to go through and fix that up before you go ahead and run that COGS report again.
Got it. So after you fix the zeros or the missed, all of the zero cost items, then pull the COGS report. That's when you would take the total from that report for the month that you're closing.
Mhm.
You would debit cost of goods sold and credit inventory. And so that's step one, is to just record cost of goods sold per the data in Luminous. So step two, after recording cost of goods sold in QuickBooks, is to now check the inventory balance in QuickBooks against the inventory balance in Luminous. Theoretically, we've already recorded COGS, right? That's what we did in step one. Now we need to validate that beginning and purchases match in both Luminous and QuickBooks. If they do, then by virtue of that, just by this equation, you will get ending to tie. I'm going to go over a few reasons why sometimes that doesn't tie. But so the first step in this phase of the process is to pull the beginning balance. So if we're using July as an example, you would pull the balance in QuickBooks as of 6/30, as of June 30th, and you would confirm the beginning balance in Luminous ties to that, which we'll look at in 1 second here. If it does, then you're good, and you're good to move on to validating purchases. If it doesn't, you need to investigate why. Figuring out exactly why they're off is honestly beyond the scope of this particular video. It could be because you didn't reconcile inventory the month before to validate ending inventory like we're teaching you how to do in this video. It could be that somebody went into QuickBooks and booked an entry after the month was closed already, and you did have it tie before, but someone booked something and it no longer ties. It's one of the reasons why I recommend that once you close a month, you set the closing date password in QuickBooks. So once you close June, for example, you set the closing date password function and you date it 6/30. What that does is no one can go back into QuickBooks and post anything before 6/30 unless they have the password. So if you're not locking down your periods in QuickBooks using the closing date password function, you're going to leave yourself susceptible to potentially not be able to reconcile beginning balance. So if they don't match beginning balance in Luminous and beginning balance in QuickBooks, you need to validate why. Where do we find the beginning balance in Luminous?
So we're going to come underneath reports again, and we're going to use the stock snapshot report. The stock snapshot report here allows us to go back to a point in time here in Luminous. And from this report, we're actually able to choose a date historically and also a time on that day, where we're actually able to come in and see starting inventory balances. So we're able to see the on-hand quantity and also the on-hand value at that specific date and time, so that you can check Luminous compared to beginning balances in QuickBooks.
And you can export this to Excel, right? So why don't we actually show everyone what column that they can sum up to validate the beginning balance.
Perfect. So we can click this Export to Excel button, and then we can see in here that there are a couple different columns that we'll see here. We have a starting inventory count here, and then we also have a starting inventory value that you'd be able to sum up and make sure reconciles.
Okay, so this is actually an important distinction. Do we run the stock snapshot report using July as the example? Is the beginning balance for 7/1 to 7/31 actually the ending balance on 6/30, or do we have to pull it from 6/30 to 7/31?
So yeah, we'd actually use the stock snapshot report. So for example, if we were using the time frame of July, we would want to set this to July 1st, 2025 at midnight to make sure that we get accurate on-hand quantity and on-hand value at that point in time from Luminous.
So that'll give us an accurate starting balance, because the opening balance at 12 a.m. is technically the exact same thing as the ending balance on 6/30 at 11:59, assuming that no orders came in right at 11:59 a.m. But yeah, so that makes sense. And then we'd want to set the ending date to 7/31 at 11:59 p.m.
If we're going the full month, we would want to set that 7/31 at 11:59 p.m.
Look at that, accurate inventory to the second.
There we go.
That's what we're talking
There
about.
we go.
Bet you didn't have that in your last spreadsheet. Now, let me recap what we've done so far. We have recorded cost of goods sold in QuickBooks via journal entry. We've now validated beginning inventory. Now we need to validate purchases. If COGS match and beginning matches based on our inventory equation we have on the screen, that means ending has to reconcile. Show them which column to validate purchases in the month.
Perfect. So in this same stock snapshot report, we can see here that we have a received count column and also a received value. And this will show, okay, what was the received inventory quantities and the received value by SKU for that desired time period, in this case from July 1st to July 31st.
So we're validating purchases, the total of the received value column on the stock snapshot report in Luminous to, what do we compare that to? We would pull the QuickBooks ledger for the inventory account that you are posting bills to throughout the month, purchase bills, right? And we need to confirm what the total is there. Now, we need to camp on this for a second because I am certain that most people don't realize that their purchases in their QuickBooks ledger probably don't always match the purchases in Luminous. This is a super important distinction. This is where accrued accounts payable comes into play, meaning received inventory that has not been billed for yet. So probably you may have some issues with beginning balance tying. Hopefully you don't. I explained earlier a couple of reasons why that might be happening. Cost of goods sold hopefully ties because you pulled the data straight from Luminous. Most of your inventory reconciliation is probably going to be focused on the purchases reconciliation. So let me show you a couple of reasons why that might not tie. Now, here's the thing. What I see a lot of accountants do is see that purchases don't tie in QuickBooks, meaning that the ending balance in Luminous and the ending balance in QuickBooks don't tie. And they just plug a journal entry that adjusts inventory to match Luminous. And the other side of that journal entry is cost of goods sold. This could be an incorrect journal entry. So do not do this without digging deeper into the variance of purchases per your QuickBooks ledger and purchases per the Luminous stock snapshot report. Let me give you an example, which I'm going to draw on the screen here. So on the right side of the screen, we're going to have QuickBooks. On the left side of the screen, we're going to have Luminous, which I'm just going to call Loom. So we've got our beginning, our purchases, our COGS, and our ending. We have that on both this side and this side. So let's say, using an easy number, we already tied out that beginning is 100 in both. So we're good. We already recorded COGS of 50 in both, which is a subtraction from inventory. We already validated that those are good. Check. Now, let's say in Luminous, purchases are, let's go with 100. And in QuickBooks, they're only 50. So you might ask yourself, how the heck is this possible? Again, where are purchases in Luminous? Where is that number? It's received value. So if you just think about that for a second and you ask yourself as the accountant, hey, do all of the bills that I have posted to the inventory account in QuickBooks throughout the month, do those all match dollar for dollar to the value that was received at my warehouse? Most every month, that's not the case, right? Why might that happen? Well, there's this sneaky little thing that I call accrued accounts payable. Some accountants call it inventory received, but not billed for yet. And so let's say you have POs that Luminous is actually correct. It's reconciled the value of your ASNs via the connection to your 3PL and the landed cost value that's been placed on those items, right? So we validated that this is actually correct. Where, if you didn't think critically about what each of these numbers were on purchases per Luminous and purchases per QuickBooks, what you would actually do is you would book a journal entry to, we'll call this at the bottom AJE. This is the adjusting journal entry. You would actually come down here and you would add 50 back to QuickBooks inventory, which actually reduces your cost of goods sold for the month. But if you dig deeper in this example, this hypothetical example, actually what it turns out is 50 of this 100 that got received in Luminous, you haven't been billed for yet. You actually need to be careful. You actually should add 50 to your QuickBooks inventory via an adjusting journal entry, but the other side of that journal entry is not cost of goods sold. It's an account you need to create called accrued accounts payable, or I've seen some accountants just call it, so that it's very clear, inventory received but not billed. The entry would be 50 debit to inventory, increasing inventory, and thus getting your ending to tie. Because if we look over here, we'd have 100 plus 100 minus 50 is 150. And then over here, we have 100 plus 50 plus the 50 adjustment is 200 minus 50 gives you 150, and we tie. But the trick here is your adjusting journal entry should be taken against a debit to inventory and a credit to a liability account called inventory received and not billed, or accrued accounts payable. Then when you get that bill later for 50, you don't post that bill directly against inventory. You've already picked it up in this adjustment right here, and instead you take that bill directly against accrued accounts payable, which wipes that 50 out, and now it's gone. This is a key distinction, because if you didn't reconcile this way, you didn't investigate the difference of 100 of purchases received via Luminous and 50 of purchases received via QuickBooks, you may have made the wrong journal entry and reduced your cost of goods sold for the month, which actually now would throw QuickBooks P&L off from the Luminous P&L, and you would be asking yourself, why is my gross margin so high? And I'm sure that there are a lot of brands that are making this mistake. To recap, received value on the stock snapshot report in Luminous is the value of everything that was received in the warehouse at any point in time. It's not the value of every bill that you've gotten in the month. So you do need to check whether or not you've been billed for everything that got received in the month, and you may need to accrue some accounts payable. You also may need to offset previous month's accounts payable with bills that you got in the current month. There's one more sneaky thing, which is prepaid and in-transit inventory. Okay, so last thing we're gonna talk about here. One other thing that may throw off your inventory reconciliation is having just one account on your balance sheet in QuickBooks for inventory instead of two. You can go 3 if you want to, but let me explain why. Because right now, the reports, and namely the stock snapshot report in Luminous, this is reconciling on-hand inventory. This is not reconciling in-transit inventory, or what we at Free to Grow call prepaid inventory. So what I recommend you do, what we do at Free to Grow CFO, is we have 2 inventory accounts. We have one called prepaid and in-transit. That's where you post any bills or payments that you make for inventory that you have not received yet. You put bills for inventory you've already received in your on-hand inventory account. Furthermore, there's one more step, and I'd be curious if there's any reports in Luminous that might be able to help us with this. What I recommend you do is you post every bill you get for inventory directly to prepaid and in transit. Just assume it's prepaid and in transit. Then at the end of every month, validate the value of everything that has moved from prepaid and in transit to on hand. And you can do that by gathering the right data from Luminous.